Why has crypto been heavy, you think, versus equities? I mean, all the tech stocks have been ripping higher. It's been a really easy trade. Well, crypto's just been choppier.
Yeah, listen, we had a huge run in some ways. Crypto is about narrative and flow, right? And so what's the story? You had a great Bitcoin story for a while, and then it kind of ran into selling. I mean, we sold 9 billion ourselves for one client. Like,
I know, with almost no impact, bizarrely.
But that swallowed all that treasury company buying. And so without that 9 billion, you're probably significantly higher.
Over the past few months, investors have found themselves asking a difficult question. If Bitcoin and Ethereum have both posted respectable gains this year, why does the crypto market still feel sluggish compared to the euphoria in equities? Despite a macro backdrop that should, in theory, favor digital assets, declining inflation expectations, a weakening dollar, and clear signals of easing financial conditions, crypto has failed to mirror the same kind of breakout seen across the Nasdaq and other risk assets. The answer, as Mike Novogratz and Raoul explore in a recent discussion, lies in the market's microstructure, the flow of capital, the behavior of large holders, and the digestion of enormous selling that most people never even noticed. In recent months, Bitcoin has hovered within a wide but stubborn range. After briefly reclaiming its all-time high earlier this year, momentum began to fade. The enthusiasm around spot Bitcoin ETFs, institutional adoption, and a potential Fed easing cycle has given way to a slower grind, one shaped not by demand, but by the quiet, steady unwinding of supply. Large-scale sales, including multi-billion-dollar liquidations from treasury holders and early investors, have temporarily capped upside momentum even as inflows to ETFs remain strong. It's a reminder that markets don't move on narratives alone. They move on marginal flows. When sellers outweigh new buyers, even the strongest story takes a pause. This pause, however, does not reflect a loss of conviction. If anything, it suggests a consolidation before the next leg higher. While U.S. equities have soared on expectations of rate cuts and expanding liquidity, crypto has been consolidating against a backdrop of the same macro optimism. The Federal Reserve's cautious stance, acknowledging that inflation has moderated but maintaining that cuts are still warranted, has already pushed gold and Bitcoin to record highs. Yet the real liquidity surge often follows, not precedes, the first rate cuts. And that could set the stage for crypto's delayed but powerful catch-up phase as markets begin to price in a looser monetary environment heading into 2026. In their latest conversation, Raoul and Mike Novogratz unpack this dynamic in detail, from the macro picture driving gold, equities, and risk assets, to the evolving structure of crypto markets and what could reignite the next phase of growth. Stay tuned as they break down why the market feels heavy today, and why that might be the exact reason to stay optimistic. Don't forget to like, subscribe, and leave a comment below on whether you think crypto will outperform equities by year's end.
But first, you and I need to talk macro, because that's how we always start. What are you thinking?
You know, we're in such a weird space. The economy is growing pretty strong. You've got a Fed that broadly said we think the economy is going to be a little stronger and inflation is going to be a little higher, but we think we should be cutting rates. That's why gold is at the all-time high. Bitcoin's at the all-time high. It's a funny world out there. There's a president who is just dead set on picking a Fed chair that wants to cut rates. There's a huge amount of debt that needs to get financed, and so lower the financing cost helps with the deficit.
Although they kind of lose the control of the long end doing that. Well, Japan certainly has, hasn't it?
Japan certainly has. The U.S. is actually the flattest curve of the three.
Yeah.
You know, they're issuing a lot of bills, not a lot of long end. And at one point that ratio's got to shift or it doesn't. And so every single person I know is nervous. And it's funny that, you know, macro, you've made money this year if you just stayed in the trades. Begin the year, you say, got to be long gold, long silver, long commodities, long the curve, and probably long stocks. And guess what? Oh, and short the dollar. Every one of those trades has worked. So you look at a company like Bridgewater, who are too big to move. You know, Ben Meltman over there right now, they're up 26%. Ben would have traded himself into a paper bag with all the Trump stuff, but that whole group
Is Ben's at Bridgewater now?
Ben's at Bridgewater. He's the deputy CIO. He's got a big job.
Wow, I didn't know that.
What a perfect place for a guy that calls them well and might overtrade them. If you can't overtrade, it's been a pretty easy. Most of my other macro friends, their performance is anywhere from flat to up single digits in one of the great macro years, because all the Trump stuff with the tariffs, with the slow, has just shaken people out of what were their predictions early on in the year.
And also Scott, who you know as well, has made it pretty clear what they want to do. They've just basically said, he's basically said, I want a weaker dollar. I want to get rates down because I need to refinance the debt, which is a rare thing for them to actually admit what they're doing. And we're going to jam the bills in the meantime. And they're kind of debasing the currency. And he's made it very clear what the trade is. And people just got freaked out by all of the political stuff.
Yeah. And listen, we're a very strange time politically in our country, right? You know, the administration, I went to the inauguration, and in the big inaugural ball where everyone was there, the president said, guys, we're going to do more in 100 days than any administration's done in 4 years. And we're going to just hit them and hit them and hit them and hit them. And that's exactly what they've done. They are moving at lightning speed on so many fronts that the opposition doesn't know what to do, but the markets feel like in chaos. I mean, the downside of it is you are undermining a lot of the great institutions in America. If it's the military, or the Department of Justice, or the Fed, or the FBI, some of that needed to be cleaned out, but you are now really, I think, you know, not cutting out the scar like the virus is, you're cutting through the bone. And that's scary. And I think the market doesn't like that. And the polls don't like that. And so we'll see what, you know, when you run into midterms.
And the other thing is, like, growth is weird as well, because we've got like CapEx growth because of the data centers, which we'll come on to, is exploding. So we've got the fixed asset investment side going up, but Main Street is pretty dead because of rates. So I can see this kind of dichotomy they've got going on.
I was out to dinner last night with it was a group dinner, but one of Scott's top lieutenants was there, and it was interesting. They see the same thing. They're like, growth is fine. You know, a lot of CapEx, not just in data center, but CapEx across the board. But unemployment, you know, but the labor statistics are harder to also get your arms around, because you're pushing all the foreigners out, right? All the immigrants out. And so, like in construction, you know, were they on record or not on record? Messy numbers, but it certainly feels like you've got softness in the labor market. That's why they want to cut rates. But you got a pretty strong economy, right? And the second quarter was really strong, and the third quarter looked pretty strong. And so it's a very, you know, I mean, in some ways it's a long equities, long gold, long risk asset market.
That's right. It seems pretty clear from that, and I don't see many major risks on the horizon yet.
Well, the only question is, it's become so consensus that, I mean, you saw Paul Jones went on TV yesterday, and I love Paul, and he was like, that's it, we're going to melt up into year end, right? Sometimes those calls become, the great butt of jokes later on in life. You're like, the great thing about Paul, he'll say it and he'll be stopped out by tomorrow.
Oh, you never listen to anything he says, as you know. He's like, he's got a 3-second time horizon on everything he does. It's like,
well, he is often, the most disciplined guy I know. And that's why I think he's 35 years of trading, and 1 year in his own account, he was down like 72 basis points in 35 years. Like, that's discipline. Don't lose your money, you get rich, right? It's shocking how many people have a few good years and they're like, oh, I had that one down 30. And I was like, what? And one down 30 takes a 45 just to get back to break even, right? And so your Sharpe ratio, one bad year crushes your Sharpe ratio.
Macro investors like Powell and Novogratz understand that the key to this environment isn't just predicting the next move, it's staying positioned for liquidity. As they point out, 2025 has been a strange year. Economic growth remains resilient, Inflation expectations are firming, and yet the Federal Reserve continues to signal rate cuts. This unusual combination has kept asset prices elevated while injecting fresh uncertainty into the bond market. The US is financing record deficits, Japan's yield curve has flattened, and global investors are shifting back toward hard assets and risk trades. Against this backdrop, being long gold, commodities, and equities has been an easy win. But as Pal highlights, even the most obvious trades carry risks when they become consensus, and that's where crypto's underperformance starts to make sense. Because crypto doesn't just respond to macro trends, it amplifies them. It's the purest expression of liquidity, and when macro funds hesitate or reposition, it feels that ripple instantly. Novogratz reminds us that the administration's aggressive policy moves and political turbulence have created an atmosphere of both opportunity and anxiety. Institutions are navigating uncertainty in regulation, fiscal policy, and debt sustainability, all of which push them toward hedges like Bitcoin, but also make them cautious about timing. And as the conversation turns back to crypto, the two men make it clear, this isn't weakness, it's absorption. It's the market digesting supply in preparation for the next major narrative shift.
Why has crypto been heavy, you think, versus equities? I mean, all the tech stocks have been ripping higher. It's been a really easy trade. Well, crypto's just been choppier.
Yeah, listen, we had a huge run in some ways. Crypto is about narrative and flow, right? And so what's the story? You had a great Bitcoin story for a while, and then it kind of ran into selling. I mean, we sold 9 billion ourselves for one client. Like,
I know, with almost no impact, bizarrely.
But that swallowed all that treasury company buying. And so without that 9 billion, you're probably significantly higher. Right? Remember, prices are set on the margin. And I think there were a lot of people in the Bitcoin world that had rode this so long that finally decided, I want to buy something. I'm not going to sell all my Bitcoin, but I got a friend that bought a yacht, a friend that bought part of a sports team, and so people trimming because it had been a great run. And you're just digesting that turnover.
And do you think that's the main supply has been old OGs plus miners and stuff like that? Is that the 100%. Main supply, you think?
That's the only supply we've seen. And the other piece has been, remember, Ethereum was dead, and then all of a sudden you've got the Genius Act plus Tom Lee and Joe Lubin with their DATs, and it became a buying machine. And so ETH had a spectacular run in the last, 2.5 months. But that's, you go from 1,800 or 1,600 all the way to 3,800. That's a pretty good run.
Yeah.
And so, on the year, these things are up, 30%, 32%. Not stunning. Good year.
But usually it's back end loaded as well. Almost every time.
And so that's the question listen, if you looked at the normal 4-year cycle, you'd be lightening up and you'd be getting flat into Christmas. Like, what could be different? Dangerous freaking words. It's different this time. There are two things that could be different. We are going to pass a market structure bill, and that plus Genius is going to allow, at one point Apple's going to have stable coins on their iPhone. Like, there's no excuses anymore that there's regulation around what's a commodity and what's a security and the SEC saying, we want you to be on chain. And so I think there's an acceleration of the existing giant players in consumer and financial markets getting into crypto. We are going to see tokenized stuff, probably starting with tokenized equities and mortgages and everything else. That's good for the narrative of all these level 1, L1 chains. You also have a president who says, I'm going to pick a dove, and we are risking Fed independence. Again,
did we really have independence though? Honestly? I don't think we did. I mean, from yelling to go from one to the other kind of shows that it's all one thing now.
Yeah, I thought that was the dumbest move a president had done, is taking a Fed governor and making the Secretary of Treasury. Literally, I thought it was the dumbest thing. I said that over and over. But Chairman Powell's his own guy. You got a president screaming that he's stupid and he's this, and he just says something, smiles and says, I'm going to do what I think is right. And so I do think there's Fed independence.
And what's coming out of this regulation? Do you have any wind of that yet? When it's going to come?
I think they're two different approaches, but you're going to broadly, I think, say that 20% threshold of ownership is decentralized. If you're under 20, open source code, a few other things, that's a commodity and it'll be CFTC regulated, and the rest will be security. What's more interesting, I guess, is once you know that, like, where security tokens can trade, and are there going to be different levels? Are you going to have to go through the whole SEC process to become a security token? And is that going to be easier than it used to be? Right? This SEC is unbelievably forward in wanting, like we tokenized our equity. That was all done compliant. We're the first tokenized equity that's the same as an equity, right? There's not but it's trading on solid superstate, which is pretty much a walled garden, right? It's only cool once it starts trading on Hyperliquid or on some decentralized platform, right? Could be Uniswap, wherever. And then you're like, whoa, now we're out in the wild. It feels like this SEC and this administration is pro DeFi. For the simple viewer, why was DeFi such a threat? Well, all the regulation around know your customer that JP Morgan and Galaxy and everyone else has to go through is different in DeFi. The protocol itself won't know their customer. The user of the protocol, the on-link, is supposed to do their best. The best they're going to do is say, we're going to use a radar gun to catch speeders. The fact that this is all on the blockchain, companies like Chainalysis and others to say, hey, we're doing the best we can to make sure no one on the OFAC list is in the trading, no one on the bad actor list is on. But you're not guilty before you, right? And if that's the approach for DeFi, like, DeFi is going to eat the world. And that's the approach it feels like the SEC is okay with.
Bitcoin's rally earlier in the year created new wealth among early holders, and with it, a wave of profit-taking. Novogratz reveals that Galaxy Digital alone sold nearly $9 billion worth of Bitcoin for a single client, with almost no market impact. That quiet absorption shows how deep and liquid the market has become. But it also explains why price momentum stalled. Those billions effectively offset the institutional buying from treasuries and ETFs. When such heavy supply is met by equally patient demand, price action flattens, even in a bull market. Compounding this comes the phenomenon of concentrated short positions and the suspicion of pre-timed trades by whales just before major announcements. In recent weeks, on-chain tracking firms identified a wallet that opened a multi-$100 million short on Bitcoin and Ethereum moments before a market-moving comment from Donald Trump on tariffs. While the wallet's full identity remains unproven, the timing has raised serious questions about market fairness and the structural fragility of an asset class built on decentralization, yet susceptible to concentrated capital. Any investor who was expecting a smooth progression into altcoin season must now reckon with how these hidden flows can act as impediments, turning anticipated rallies into grinding ranges. In short, the rhetoric of next leg up is still valid, but the mechanics underneath the market have changed. The days when retail FOMO or momentum alone could kick off a rapid run seem past. Instead, the market is now being managed, whether intentionally or structurally, by capital that can act with discretion and scale. The point is not to suggest doom, but to emphasize that the pressure under the surface is real. Large holders locked in profits, whales building short positions, and regulatory uncertainties all combine to make the near-term outlook less about a smooth ascent and more about navigating a consolidation period where patience may pay instead of speed. Going forward, well-informed investors should keep one eye on the macro narrative that Powell and Novogratz outline: tokenization, regulatory clarity, institutional adoption, and another eye on the flow and structure of market participation. The true breakout will likely come not when everyone is shouting altcoin season, but when net supply turns decisively positive, when the shorts begin to cover, when the narrative intersects with fresh capital being locked in at scale. Until then, be aware that for every bullish headline, there is latent counter pressure, and victory may come from positioning and conviction, rather than trying to capture the next leap prematurely. So as we enter the next chapter of this cycle, the lesson is simple: stay patient, stay positioned, and stay informed. The groundwork for crypto's next rally is already being laid in the macro, regulatory, and institutional layers of the financial system. Thanks for watching. If you enjoyed this analysis, make sure to subscribe, hit the bell for updates, and share your thoughts below on when you think the next big move in crypto will begin.